we have a huge suite of services and a lot of expertise in these different pieces. And then for us, what we do is it's an a la carte model where it's like, what do we need to piece together to give the best outcome for this business? What are the things that are going to move the needle for them? And that's where our AI system comes in, which creates both efficiency because it does what an analyst would take 4 days to do instantly and lets us know exactly what's working and not in a company's marketing. And we can plug this into all these acquisitions as well as our own business and create just way quicker decision making, way faster analysis, and actually use AI in a way that I think is more beneficial than all this generative AI that isn't there yet. And it just looks cute, but it's not really actually replacing any work.
So I'm so excited today to have Erik Huberman with us from Hawke Media. For those of you involved in agency M&A, you've heard about what he's doing, and we get to today really go deep into what he's doing on his Hawke Media, from his programmatic M&A processes, as well as digging into his venture fund, as well as the Hawke AI and other things that he's doing. So first of all, for those of you who don't know Erik is the owner and founder of Hawke Media. He built his first business at the age of 6, which started his entrepreneurial journey, which has only accelerated since then. And he launched Hawke Media. We'll hear about the history of that and then how he's leveraged acquisitions in order to scale that. So far, they've generated over $2.9 billion in gross revenue for their clients, 4,755 in growing brands. He's invested in 50 companies through Hawke Ventures. They just closed their $20 million fund. And he has 44 that he's also has angel investments in. And I was going to share the number of acquisitions that I have here, but I'm sure by now it's totally.
I'm curious, what number do you have?
I have 12.
Yeah, it's 18.
Yeah, 18. Okay. So, okay. And I know another week or two, that'll be a wrong number anyway. So let's jump in. I'm going to ask some very direct question. I'm going to start with the entrepreneurial perspective. Okay. Every entrepreneur, when we look back, we can think about those moments of really high highs and kind of say it's kind of like climbing a mountain. You're on the mountain for a nanosecond and then you're off it. But there's high highs, and then there's lows that we've all encountered that would break as successful entrepreneurs, that would break most people, and when they would never do this again. So let me ask you this: if you think about your highest high, where you're on the top of the mountain, wind at your back, and saying, "Oh my God, this is incredible." What is it?
Yeah, it's a I don't know whether it's a character flaw or actually what helps me get to success, but the high highs last, as you said, nanoseconds. Like I'd say probably the biggest one, which lasted about 5 minutes, was when I got Forbes 30 under 30. And I've reflected on this since, because I was like, why did that matter so much to me? I don't really care about external validation that much. It was more the intrinsic validation of I was a year younger than everyone. So if you've read Outliers and Malcolm Gladwell, I was a head shorter than everyone growing up. So I was never a star athlete. I was athletic, but like not like just in like a moderate way. I was never the best at really anything, but like, and I wasn't that great of a student, mostly because I just didn't want to be. I was always smart and I never like doubted my own intelligence, but business became my thing very early. And so that validation of like, oh, I am one of the top young business people was just such a like, cool. I was young and I found my superpower and my, zone of genius. Like that felt really good. But again, it was like, I thought I didn't get it, but I was scrolling. I still remember the moment. I was walking by our office on the sidewalk and I was scrolling through the list, looking at all my friends that had got it. And then I scrolled past my face and I paused for a second, scrolled back down and literally jumped up in the air because they all got an email telling them they got it. And I just didn't get that email. And so anyways, that was really exciting. I went back, high-fived my team, celebrated. And then like literally 5 minutes later, what's going on with the numbers? We got to get back to work. Like it was like, that's it. That's the celebration. And so that's one really interesting thing that I try to force it a little more now, where it's like when we have a milestone, like I'm not a materialistic guy. I don't like buying nice things, but now I'm like, maybe I should like buy something as a reminder of like, I hit something. Like when we closed our second fund, I bought my first watch because I actually planned on it because both my wife, one of my best friends, my business partner were like, you need to like go do something like that. And I never got it. And then we closed the fund. I wasn't going to do it. And then I went and did it because I don't really give a shit. And I was like, now when I wear it, it's like, it's a reminder that I succeeded at something. Like the problems are all ahead. We all know that shit's hitting the fan, that something's coming, and I have to deal with a fire. But pause for a second and go, no, I accomplished something. There was a win here. And I think it really helps with the mental game of it.
I'm really bad at that also. One of my partners in my business was really good about making celebrations, bringing the whole team in. And I think that leaning into your team, letting them to feel that moments are really great. There's a level of humility that I like to see things quiet, but from that perspective, really important. So if you look at one of those moments that was your low, and I don't know whether you say you hit a concrete wall or a concrete wall just fell on your head, and you had that, could be a moment of doubt, but what was the lowest low you've ever had in your entrepreneurial career?
Yeah, I mean, without getting too much detail because I can't share some of it, I had a lot of, at the same week, I had a bunch of executive problems, a bunch of family health problems. I had just lost my dad, had some serious headwinds in the business, and like it was just got punched in the face like 8 times in a week, and finally hit my breaking point where I was like, I don't want to do this anymore. And like that was like 2.5 years ago. And what's interesting about that, we talk about the nanoseconds of celebration. It took me a year to get back to like feeling normal. Like I didn't know what anxiety was. Like actually, in hindsight, I literally didn't know what the feeling of anxiety was until that week. And then I was like deeply anxious it got better and better and better over time. But for months, I was deeply anxious, woke up every morning dreading the day. Like, and frankly, that was that you kind of talked about it. Like that was that moment where I understood mental health and all that to a different extent. And I went, I get why this breaks people, but I'm just going to keep pushing, like one foot in front of the other. Fuck it. Like we'll see what happens, but I got to just keep pushing. And thankfully in hindsight, it was the right move and it went well. But yeah, God, I've broken many bones. I'm an extreme sports guy. Like there is nothing worse than having deep anxiety. Like there is nothing more physically painful than that. Did
you actually have a panic attack along the way?
Never had a panic attack, but I mean, couldn't eat, couldn't sleep. Like it was, I think I lost like 10, 12 pounds in a week. Like it was like bad stuff.
Wow. Now, the outside world did not know this about you and your business, correct? There was different.
Not everybody, but as open as I'm being right now, I was pretty open. I talked to friends, I talked to colleagues. I talked to my business partner. Because again, it was the reality is anxiety doesn't come from where you are now. It comes from your fear of the future. And I got hit so much that I thought that I was waiting for the next thing. It wasn't about like, I was already where I was. I'm still alive. Fucking company's still going. Like, it's not that it was like, it didn't have to do with what happened. It wasn't regret. It was a little annoying. Like if I'm being real, I was annoyed and angry at what had happened because there was some betrayal in there and things like that. But like, it was more, I don't feel like we have enough solid footing now to take more challenges. And so that's what's interesting is like we had come from this really high place too. The business was on a growing gangbusters. Everything was great. We were profiting like crazy. We had built a full executive team. I felt like I could rely on everyone. And it just brought me down to earth quickly. And so it was more of the juxtaposition of the change in pace that we were at. And, thankfully going through that, now I know how to handle it in the future. But it was the first time that you take punches always running a business. You're always getting bad news. Like every day is something. So it's not that was normal to me. It was just, I got hit so much that it was just like, you can kind of take a deep breath and move through it so many times, but it's like, the whole step on my head while I'm drowning thing from Wedding Crashers. Like it just felt like someone just kept pushing me down that at some point you suffocate.
As entrepreneurs, I feel that as we go through our processes and the what the fuck or oh shit moments and these things keep punching in it, we develop these calluses. It just, okay, we did this, we've been here before, we're going to get through this again. But sometimes it does just take our breath away. For me, everyone has different physiological reactions. Mine is I feel a little bit of weak in the knees and my thighs, and I feel those as far as when this happens. And it's a sense of just a lack of control. But I think that what separates successful entrepreneurs from those that don't is we just keep on going. We don't know the word quit. Because you have some level of momentum no matter what, and we just don't give up.
Well, not just that. It was, I looked at, and I was open with my wife about it, who's a senior executive private equity fund and like sees this all the time. And I was like, I don't want to do this anymore. Like if I could just hand this off to someone else, I would probably do that. But I know that that's irrational and I know that I'll get through this. So I'm going to ignore that. That's my feeling. But I'm not going to go with my feeling because I know that that's irrational. I'm self-aware enough to know. And that saved me in a lot of ways, was knowing how ridiculous my own feelings were and almost being frustrated with my own feelings, where I was like, I'm looking around. Thankfully, I've been successful, to be clear. So like I'm sitting in a nice house. My family's taken care of. My personal finances are fine. But I've worked 10 years to build this thing, and I saw it, I saw it irrationally going away. Like if anyone from the outside looked at it, they'd be like, yeah, I mean, you had a couple hard months. The fuck is the problem? Like you had a bad executive. Move on. Like stop it. But the emotional hit from that was so hard and so over the top from what the actual reality was. Thank God I was self-aware of that, because if I had just gone with my emotions, there might not be a Hawke Media right now. I might have just been like, I'm done. Good luck. Everyone get out. Because I really didn't want to do this it was a good 6 months. Every morning I was like, I hate this company. Now I love it again, to be honest. Like there's still pieces that I'm like, oh, this is annoying. And like once in a while that anxiety kicks up. Like there's almost like a PTSD side to it that gets easier and easier as time goes on. And I also dove full force into how to get my mental health in order. Because I was like, this is awful and I'm not going to deal with this. Like, I'm going to fix this. And so there's a lot of frustration in that because it's not a quick fix. It's like, I realize like the best way to think about like a situation like that where you really get hit that hard, it's a brain injury. And you've got to heal, you've got to do physical therapy, you've got to work at it, and it will heal over time. And it may never be the same, but you can get quite a bit back. Just like when I've torn a shoulder or like whatever, like it's like that, it's the same exact kind of thing. And, it's painful to work on it and you have to try different things and then you find that thing that works, and was able to find a lot of things that worked. So I don't know that wasn't the whole topic, but you asked.
No, it's a great analogy there. And I think it's just good takeaways for people to understand, because entrepreneurs, this is a difficult journey. It's a lonely journey. Some of us have had partners along the way, and sometimes you're alone in those journeys. And this is just a natural part of it. So before founding Hawke Media, you had two businesses that you scaled and then you sold. Can you tell us about those exits?
Yeah. So the first one was called Swag of the Month. It was one of the first e-commerce subscription companies. And after a year and a half, this is a long story short because I could take hours on this, but we sold it for just enough to pay off the debt I was in for 4 years in startups. And so it was a really fun situation because I sold a company, which is usually celebrated. And this is where it's fun to be able to cut through the bullshit, because I sold for just enough to be flat broke with no job. I just wasn't in debt. I was flat broke with no job. So, yeah, it was a funny experience because it should be celebratory. And we made money. But again, like starting these startups, it was my second startup out of college after working a year in real estate. I started 1 week before Lehman Brothers collapsed. So that was fun. But yeah, I mean, listen, we built that company. We timed the market right. We did well. And we just got to a point where it wasn't sustainable without raising money. And we didn't know how to raise money. We pitched one VC. He said he couldn't because he invested in a similar company. And then we're like, well, that's out. And then someone offered to buy it. We're like, yeah, sure, done. And then I got recruited by Science, the incubator that had just launched Dollar Shave Club, and started advising for their portfolio brands, including DSC, and then helped them launch an activewear brand that we sold a year later to Bowie Total Fitness. Then I spun out. I started advising and consulting for a bunch of brands similarly on the marketing side, and realized how broken the marketing ecosystem was and how, frankly, like 99% of agencies really don't know what they're doing or how to build businesses. And there's just so much bullshit in our industry that I went, I'm just going to hire my own little SWAT team to help here and then go from there. And that was a decade ago. And now 250 people later, venture fund, an AI system, pretty solid company. That's where we ended up. But it was not like a business plan and a thesis and I'm going to do this. I never raised money. It was just one foot in front of the other.
Incredible. Now, how many agencies what's your pacing right now for acquisitions? How many a year?
Yeah, we're trying to end this year like around 18 to 20. We're trying to do about 2 a month. That's more of an operational limitation than it is anything else. Like that is actually putting a lot of pressure on my team, which is, I've had the phone call I had as we were sitting on here to get started is like, hey, I need help on how to think through how to prioritize this. So, but it's a thing that I've learned this over and over again. Make hay when the sun shines. And right now we've found that like it's a win-win situation, win-win-win. I'd say it's win for them, for us, for their clients. Like it's a really good situation we've been able to unlock. And so I want to lean into it as long as it's an opportunity for us.
What's your sweet spot for size right now?
Yeah, like 1.5 to 4 million.
of revenue and EBITDA?
I mean, standard agency, you're doing 20% usually, but 10 to 20, I'd say, is kind of the range they're in.
And you, regardless of how good, of course, your deal is very standard and structured. So there's no such thing as a great business, great opportunity, financially in trouble, and therefore negative EBITDA that would you ever buy that?
Not if we can't fix it before we close. Like, we'll maybe help coach them on how to, we've done that where it's like, hey, you got to do these things, do them right now. Let's talk in 1 month and then get it done. But sometimes we're the push that some people need to get their business where it needs to be. And so we'll do that actually. Yeah. But in terms of taking it on and then us having to clean it up, no, I don't need to do that. Like that's just usually a function of not making hard decisions.
Fast forward 2 years from now, 2026, acquisitions pace still 2 a month, same level on averaging about 2 to 3 million of revenue.
It just depends. I mean, working capital constraints become a thing because we're now covering all their payroll and all their expenses, and like the actual shift of working capital becomes, a constraint for us that as a bootstrap company is a thing. So we've actually started exploring, should we bring on growth equity? We do have a line of credit, but we're seeing if we end up doing that, then we can go a lot faster. If we don't, it's more reactive in the sense of I don't know really what to anticipate about working capital then, because we're also making profit. So my assumption is we'll end up with more capital on the balance sheet. We can go faster, but until we actually realize that, it's hard to anticipate.
What is your goal for the agency? Marketing
world domination. I want to just growth. Thankfully, from year one of this agency, my personal bills are fine. This has never been about my personal wealth or how I do, buy a boat or a house or whatever. That's not what I'm doing this for. It's not about the financial outcome for me personally. It's literally a scoreboard and this is what engrosses me. But what keeps me engaged is better than last month, better than last year. I don't care about competition. A lot of my friends run a lot of our biggest competitors, and I have dinner with them. I celebrate them when they have exits. I posted about one today. One of my friends just sold his company, and we've competed with them. I don't care about what other people are doing, but I do care about me being better than I was before. And that goes back to that mental health experience. That was the first time we really saw a decline in the business. It was March, April, May 22. Which everybody saw as a hard part in the industry. But that was the first time, because I'd only been doing it 8.5 years, that I'd experienced anything like that. And that was hard to get my head around, because if I see progress and growth and forward momentum, I have all the energy in the world, all the joy in the world, and I love this fucking company. But going the other direction sucks. And it's going to happen. It happens to every entrepreneur. And so getting my head around that was an important lesson. But now that it's doing the other and we're growing and building and we just had our best June ever. I think July will be the same. We're seeing this new leg of momentum that it's no, this is really fun. So I don't need a finish line in that sense. I just want to figure out how to keep going.
Global market domination, but right now, no plan on exiting 5 years, 10 years, or
no. It's more if I do bring on growth capital, then they're going to want an exit in the next 5-7 years, whatever that timeline is. So I'm going to have to start strategizing that, which, listen, I have all the connections. I've had all the conversations. I'm not worried about leaning that way, but that doesn't mean I'm personally exiting, because what this has the potential of, if I get that growth capital, I actually could get enough size here that this could end up being a publicly traded company for that exit, or I could bring on bigger PE as the partner. So it doesn't necessarily mean that I'm retiring, and I'm currently 37 years old. And there is not going to be, I would be shocked if I end up at a point in my life where I actually retire. So for the time being, this is still a blast. And as long as I can keep making it fun, I'm not going anywhere. Unless someone wants me to. To be clear, it goes the other way too. If someone wanted to buy it and it's an absurd amount of money and they want me out and they hate me, but they want to buy this and give me a ton of money, fine. It's not emotional the other way either, because I'm not worried about finding my next thing to do or jumping into something else either. But I do love this, and so I'm not looking for that.
If you're comfortable sharing, what is your monthly, what's your run rate right now?
On a net revenue perspective, I think we're about 32, 33 million.
How much media do you control on a yearly basis?
A little over $500 million.
And then what's your focus as far as the work you do?
It's ROI generated marketing. So, but that has a very wide net when you know what you're doing. A lot of people think that all you do is spend on Facebook ads and that's what drives returns for companies. It's like, no, like what's their website look like? What's their email marketing strategy, their SMS strategy, their content strategy, their production strategy, their, every piece of that falls into it. The only thing we don't do is events and experiential. But other than that, we have a PR team. We have, and especially through M&A, we've, our five most recent acquisitions, one of which we haven't announced yet. It was an Amazon agency, a video game focused strategy and creative agency, an agency for more big dealers and manufacturers that like just jacuzzis, AOR, PR agency, and now we just acquired a B2B marketing agency with a call center. So we have a huge suite of services and a lot of expertise in these different pieces. And then for us, what we do is it's an a la carte model where it's like, what do we need to piece together to give the best outcome for this business? What are the things that are going to move the needle for them? And that's where our AI system comes in, which creates both efficiency because it does what an analyst would take 4 days to do instantly and lets us know exactly what's working and not in a company's marketing. And we can plug this into all these acquisitions as well as our own business and create just way quicker decision-making, way faster analysis, and actually use AI in a way that I think is more beneficial than all this generative AI that isn't there yet. And it just looks cute, but it's not really actually replacing any work.
Why would a seller sell their business to Hawke?
Yeah, it's pretty straightforward. It's thankfully, there's two sides to this. One is if you're going to sell to us in the way that we buy, you got to trust that we're actually going to do what we say we're going to do and that we're, a good partner. Thankfully, we've done 18 of these. Talk to any of them. So we're really open. Just talk to the guys we've already done. See what they think. They'll tell you the good, the bad, and the ugly. And I'm happy they do that. They tell you exactly what we fuck up on. And I'm very open about this. It is not all perfect. There is stuff to work through. There is, especially when we first integrate, dealing with stuff, it's not perfect, but the outcome is better. And I can say that very confidently, objectively, because they'll all tell you that. All the companies we've acquired over the past few years will say, no, this is great. It has worked out really well in the end. And so the proof point's really important. And then the second part is you've been running an agency making, I don't know, let's just take 2 million in revenue and 400 grand in EBITDA. And you're doing all HR, accounting, legal, operations, sales, client success, because at that size business, you might have some of that off your plate, but you're still having to oversee all of it. And I come to these guys and go, why don't you join us? We're going to take everything else off your plate. Just focus on growth, which is what you started with. And let's just put you in your zone of genius, in your sweet spot, take all the other bullshit that you have to deal with off your plate, and let's grow this together. And thankfully, we have a whole infrastructure to give you. So it's really just, I joke that it's like a reverse franchise model where we'll give you all the infrastructure and you just grow the top line business and you'll benefit from that. Don't worry about your P&L. Don't worry about servicing. Don't worry about all these other things. And that's most of the deals we do. Now, there's also a smaller cohort of they have a great service. We want to augment our services. So why don't you become our entire affiliate department or our Amazon department? You're going to come in and take that over. And then you're going to have a 30-person sales team and a marketing team and all these things you don't have right now. We're going to grow it together. So those are the two types of deals we generally do, as well as a third, which is, I don't want to do this anymore. Take my business and find a home for my people and my clients. So we have kind of three archetypes, but the two in all three work. And again, for me, as long as they're transparent about what they're trying to do, I'm sit in their seat too. I'm a founder of an agency. I've been there. I know I'm not going to set up a deal. I don't pull one over on people. So it's just this is the deal that I think is good for you and me that I can do, but that you're going to enjoy because we don't make any money on the back end.
So help me out with this. I have a $4 million podcast agency. Okay. Throwing off about 25% a year. And I come to you and say that, so you buy a podcast agency and I have my team, I have my processes, and I have the way we've been running it. We've been running it extremely lean. My people are just a little bit tired because I push margins and, we have limited resource, typical thing, and we're scrappy. And I come to you. So what is the deal structure, the financial deal structures, and then what happens to my business after close? And I love my team. I love my business. I want to continue on and lead my team because we're growing really crazy. We just want to accelerate our growth.
We all become one team really quickly. And so the deal structure is, honestly, the deal structure depends. It depends on taking that person example. Do they want to run the podcast department of Hawke Media, or do they want to work on scale?
Let's just say they want to, because they can't do both. They can't generate new business for the podcast division and run their business.
Not the way we want to scale it. No.
So let's say they want to run the podcast division of.
Then we basically come to if they're running at good margins, we basically look at the margins. We set up a margin profile. and everyone gets a salary, like that's table stakes. So they have benefits and all that, which frankly, a lot of these companies don't have benefits and they haven't even have their own healthcare. So like we're able to skip them all that, which is a little bit, but then we basically build a model based on like where they're at and where we think we can take them that shares in the upsides. The idea is keep what you're already making. So keep that 25% of EBITDA, that money you made that you're still making. We're not going to touch that. But then going forward, we want to manage this department in this margin. Let's do it together. We're going to drive sales. We're going to manage the overhead, accounting, all that, et cetera. And you're going to share in the growth of that with us. But you've got to manage the margin and make sure that we're delivering. So it's really, for the people managing the department, it's more about a margin conversation, gross margin conversation. And for the people on the growth side, it's more about a top line growth conversation.
Now I understand, because I was really confused on the way that is, because I couldn't figure out when I thought it was a pure revenue. And I'm thinking then most people who buy business said, well, let me increase everyone's salary and I'm sure these resources and I want this infrastructure in place. And typically they want to just spend money.
Yeah, when someone's being like if someone's on the growth side and incentivized by revenue, they have no say over the cost structure. We're managing that now, which hasn't created much friction, to be clear. The only time that happens is like we've had it happen once where someone frankly didn't tell us their numbers correctly and we acquired them and they were underwater. And we're like, yeah, we got to cut a couple of people. Like you told us you were here, you're here. You can't afford this. And unless you have like some huge pipeline in your back pocket that you can close today, we've got to cut a couple heads. But generally, we're taking on everybody.
Okay. So let me just go back to the one agency. My agency is basically has an EBITDA of $1 million a year. I'm just putting hypothetically. And of course, not all that's a distribution because there's some money that's put inside the business. Let's say it's $750,000 I'm able to distribute out a year. Okay. Now, being in front of Hawke, and what I heard you say is, and I want to go and keep on running this platform, is the 25. So how does the economics work there? Just maybe.
We do distribute. You get to distribute the full amount. You're not We're not making you like your profit is now your profit. It is not working capital. It's not. We don't keep the profit in the business on that piece. And so again, it's hard to say it's not a one size fits all model. So it's hard to be like this is the deal. But in that case, you probably would be assuming you maintain your business and everything stays the way it is with taking the growth piece out of it or the margin share, you would be making $1 million a year off that book.
Okay. And then everything incremental, that's incremental. Okay.
Correct. That's exactly right. And so on top of that, the way we make it sustainable, because usually you're probably going to lose a couple clients or over time, we all lose clients. It's a fucking agency. So there's going to be things like that. We end up cushioning that a little bit there are synergies. Like you probably got a CRM. So do we. We don't need yours anymore. We usually are able to find another 5 to 10% of EBITDA in stuff that's just overlap in softwares and consultants and contractors and tools that just we already have. So there's some operational efficiency that happens there that ends up covering some of that too and creating a margin of error, so to speak.
Now, if I have my team, been working them forever, and if I'm running the podcast team for Hawke Media, then basically it's my team. I'm managing in the way I like to, and I can kind of keep the culture in place that I have, or does it become the Hawke Media culture?
Culture is a funny category and word because I think culture is ever evolving. And when we bring on new teams, the culture ends up kind of morphing into the joint piece of it. So I don't think it depends on the business, but I would argue a lot of agencies now are remote. The culture, other than the way they focus and stuff, they're very easy to integrate from what I've seen because it's especially when you have a hardworking, solid team that wants to build a good business, then we're good. The only time we really deal with tough culture is the opposite. You haven't been working hard. You haven't you've kind of been stagnant. That's why you want to get out. And you haven't had hard conversations with your team that yeah, this is not a 20-hour a week job. Got a couple of those that it's we've got to, now help them learn what real work looks like. And that's a little different.
From the team again, I'm seeing some teams that are used to, in the agency world, they're used to filling out time cards, they're used to being managed on utilization, and it's just part of the way they do that. And then others that the thought of someone actually managing utilization and having someone overseeing them and putting pressure on them, and they're no longer with the thought as I got my work done, so what does it matter? And I put in my 20 hours a week. That's a shifting culture, and some people can't handle that.
Yeah, and I would say once in a while we lose a couple people. especially if someone's already on their way out and then the company announces that they're being acquired, usually there's like a couple people that'll give notice, but funny enough, most of the time they retract that. Because we like the upside is a lot more than the downside when we acquire an agency for the people. You now have way more upward mobility, way more opportunity, way more exposure, way more diversification of your tasks, your jobs. So like there's just so much that opens up for these people that are working at these smaller agencies that it's generally good news, other than the cliche fear of like, oh, are they going to cut everybody and scrap it all? Because everybody's heard that story, but that's not how we operate. So when we come in and go, no, none of you are fired, and like we're going to just now build this, generally it's good news. And again, the honeymoon phase wears off, and then it's like that's where like a couple times it's been like, yeah, sorry, like this is not going to be a 20-hour a week job. Like that's not. We've had to have some hard conversations on that stuff, but yeah.
And then there's other things that. And nothing goes right in integration, and depending on how you handle the people and the relationships, it either can go negative or positive. One question left about integration, I'm going to switch subjects to your fund, which I'm fascinated about, is from a resource allocation. The challenge I always have in the company is that, and I'll make it very simple, IT. Your podcast division has their wish list of everything they need from IT support and the programs and everything they need. And and everyone, as far as if they're leveraging Hawke AI, then everyone has the priorities of must-have they do. So everyone's fighting for your business development resource. Every department's fighting for your IT. So your lead gen, your marketing. So how do you manage that?
No. And I say that kind of tongue in cheek, but it turns out people need probably 10% of the tools they think they need. And we go through processes pretty much monthly, bi-monthly of like going back and cutting a bunch of stuff people asked for and being like, did you actually ever use this? No, great. So we like thankfully have a great head of services that monitors all that goes like, do we really need to be spending on these things? And like, what do we have that can supplement it? Like, how much is this actually saving us in time? Like, he's really diligent about that. And so I say no, and we're spending, millions of dollars a year on tools. But the point is like, there's definitely pushback on like, is that something we really need?
And there's the detail stuff, which I won't get into, is what happens when you buy a shop. They're using Slack. You don't use Slack internally, and therefore other clients are on it. Where they communicate with they use basically Google Files, your Microsoft shop. So
this is the benefit of how we do deals. Is like that. Thank you for that point. If there's anything we need to keep, it's profitable. I don't have to do anything. We're going to do it because it's efficient, but if there's a tool that is how they've managed all their clients, and if we change it up, it's going to shake up everything and make it a nightmare, then yeah, let's not do that. Let's keep that tool. It's more like they're using, we're using GC for email and they're using Outlook. And it's like, all right, we're going to switch to over time. Like none of this is like rip the Band-Aid and scare them all. Because again, when you buy a profitable business, you don't have to do anything, but over time you want to.
From your deal structures perspective, what is your average time to close?
I'd probably say 2 months.
2 months, because everything is pretty much templated already at this point. And what happens when they insert their attorneys who want to renegotiate everything and protect the client and their tax advisors, everything else?
So the nice thing is like we've been through it enough that it's like sometimes people try to literally rewrite the deal structure. Like, listen, attorneys want to make money and show their worth. So like red lines are just what they think are showing their own value. So sometimes it's reasonable. And we just like, instead of like shutting down their attorney and making him look like an idiot, we just go, yeah, okay. Cause like sometimes an attorney will redline an entire agreement. And then we read the substance of it and they change nothing. It's just, we had an attorney do this. He just basically wanted to re-articulate the entire contract slightly differently. That really didn't change the actual function of any of it. It clarified a couple things slightly, but it was already clear, like that kind of thing, that it's like, yeah, okay. But then we get attorneys that literally try to change the deal terms or try to negotiate on their client's behalf. And that's when we're like, no, and we're not playing this game. Talk to your attorney and put them on a fucking leash, or we can walk away, because I'm not going to waste my time with this kind of and it's a little bit of we've been burned in that sense, where it's like, when this has happened, like you and I, like meaning I'm talking to the founder, you and I have a deal. We have a term sheet. We agreed to terms of this deal. You now have an attorney telling me that those terms are off the table. We're not playing this game. We're not retrading. And I've had to have those hard conversations a few times. And honestly, most of the time it's been well received, where they're like, okay, let's, by the way, you also, I think as a buyer, can't fault anyone for shooting their shot. I think that's insane too. Like to get angry that someone's going to see if they can get a little more, like you can ask. But if you push back on the answer, that's when I get frustrated. I'm like, you can ask all you want, but like the answer is no. Same thing with the tax stuff. It's like, this is how we do deals. Like, can we get slightly creative with it? Sure. But like, we're not going to get too, I don't want the IRS involved in this. So this is how it's going to go. And, that's it.
Your fund, I'm just going to switch gears, is, okay, so what is your fund? What does it do? How'd you raise it? How'd you structure it? What was the thought behind it?
Yeah. So 1 year into business, thankfully, again, made good money even the first year. And I was planning on taking the cash flow from Hawke and investing in real estate. And my family all comes from real estate, and I had good guidance in that. And then a friend of mine approached me and said, hey, we're pivoting to e-commerce and we want you to be on our cap table. We want you to be an investor. I was like, guys, I'm not investing in startups. Like, I spend all my time in risky shit. I don't need to put my money there too and just turn my life into a nightmare. And they're like, no, we're not asking. We're telling you you're going to invest. It can be a small check, but you're going to be in our company. I'm like, all right, fine. I gave them a small amount of money. That company's called FabFitFun, multi-billion-dollar company now. And I was thankful that I took their demand and went with it. And so then I went, maybe I shouldn't be so stubborn about this. I invested in a few more companies. It was about 7 over a couple of years, and they all did really well. And so then I hired someone to help me manage those, as well as we were doing some sweat equity deals at Hawke, which didn't end up doing well. So that person, Drew, said, hey, these investments have done great. This sweat equity is worthless. Like, if someone's willing to give us a big chunk of their company to be their marketing team, it's because they don't value their own company. So let's stop doing that. And he's like, let's just write bigger checks. And I'm like, yeah, I'm not made of, like, I don't have unlimited money growing on trees. So like, I can't just write bigger checks. And then we were like, well, maybe it's time to raise a fund. So went out, raised $5.6 million and got more disciplined on the thesis, because now it's other people's money. So we need to not just throw money. Like, that sounds cool. Here's some money. And it became, let's invest in the tools and software based on our angel investments, based on what we saw in the market. We saw that we had missed a few and bet on a few that did really well, of all the marketing tech and e-commerce tech out there. And so we decided to focus on that, focus on deals that we could actually deploy across our clients, be a market maker for them, also do diligence on them very easily, because we could use the tool and see if we actually like it. And so that's what we leaned into. And, first fund did well. So started raising our second fund at the end of 21, did our first close in February 22 and our last close in February of 24, raised $20 million for the second fund. And have about 60 companies that we've invested in between the two funds, and another 40 something off the balance sheet at this point.
That's amazing. And what's your average check size?
Now $500,000.
And what stage are those companies when you invest in them?
Pre-seed and seed, like early stage marketing tech, e-commerce tech, commerce enablement. Like, we want to get in. Like, we need like, market validation is nice, but we're more concerned with, like, do we actually like the product? Because there's companies that frankly have raised $1 billion that I don't think are great companies, and they end up falling apart. And there are companies that have no revenue that I go, wait, this is actually a great tool. Let's jump in. Like, Postscript was brand new when we invested, and that is the best bet we've ever made. They're an awesome company.
I didn't know you invested them.
Yeah, we're in their first round. So like, that is our, we put both funds in that. That has been an awesome bet. We were in Klaviyo, but we invested a little later, but that was a balance sheet investment. We're in Tapcart off the balance sheet in their very first round, which that was a $2.5 million valuation. So we have done very well in these early stage companies, because I didn't need Tapcart to have traction to go, oh wait, this is great for our clients. Like, this is exactly what they need. I love this, because we were dealing with clients at the time. It was like $100,000 to build a mobile app. I'm like, wait, how much is this? Like $100 a month. I'm like, fuck yeah, let's go. And so it's those, like, and that's a little lighter than we do, to be clear, but that's kind of the diligence we need. We don't need diligence on, like, well, let's make some phone calls to operators. Like, we literally are the customers. So let's go check it out. If we like it, we see so much now that we have the benefit of knowing the market. And it's fun, because now, like, we get flooded with deal flow, and we want it, not because we invest in everything, but because we know that there's 10 companies trying to build the same thing right now. And we're seeing the difference between each of their strategies, and we're able to bet on where we agree with the strategy. And
then when you say pre-seed, they all have a product that you can test. It can't be concept.
Correct. And I usually like a little bit of revenue. If they don't have a team that can get it to market and make some sales, like, that's a bad sign on the operators, frankly.
Who makes the decision on the investment, on whether you're going to bet on this company and the CEO and this team?
Yeah, it's consensus between the four of us. So Hawke Ventures has 4 people on it. It's me, my co-founder and president of Hawke Media, and his name's Tony Del Mercado. Then it's Clark Landry, who is one of the most successful angel investors in the space, period. And he was going to start his own fund, but we decided to team up. He was the first angel investor in AngelList, Trade Desk, 15Five, Crexy, and Scopely. Like, insane success there. So him, me, Tony, and then Mara Chabin, who's our principal, who's grown up with us from associate through principal, that is just a rock star, and she is a part of it too. And again, there's seniority there, but if it's not consensus, we talk it through. If anyone says, I don't think so, it's taken very seriously. And there's no majority, because if someone's actually adamant about not investing, we all respect each other enough to not invest.
How much, if you find an amazing tool technology platform that's a clear home run, how much weight do you put on the CEO then, the founder?
Oh, tons. I mean, that's the lesson I should have never had to learn, because it's the cliche too, is like, you have to bet on the jockey, because there's a good chance they have to pivot. There's a good chance they have to make adjustments. And frankly, even more than that, like, hopefully they don't have to pivot, because again, we're betting on softwares that we're like, no, this is great, we need this. But they have to work through some hard shit, like we talked about earlier. And I've watched founders of companies that have a great business. COVID, like, we've been investing pre-COVID too. COVID hit and took out a couple of our portcos because the founder stuck their head in the sand. And like, it's things like that it's like, if you're not ready to go to battle, that's an important part of it. And like, Paige Craig was an advisor to help us stand up the first fund. The guy, I don't know, he's a pretty prolific angel investor and venture capitalist around the country. And before that, he ran a private security detail in Afghanistan and Iraq. And so his line to me when I first met him was, when you've negotiated across a table from someone that wants to kill you, entrepreneurs are pretty easy. And like I watched how he picked entrepreneurs. And one thing he said to me early on, which I kind of highlighted here about the sweat equity thing, was you need to invest in the ambition of the founder. And the founder, if he's not going to be what we've talked about in the earlier part of this podcast, they're not going to run through a fucking wall when it's hard, then you're not, it's going to be, I don't care what the company is, it's going to get hard. There's going to be, when you're doing pre-seed and seed, you're talking about a 10 to 12 year arc usually, and maybe up to 20 if you're talking about Palantir or Reddit. And so, or was it, no, Palantir, yeah, or Reddit. Was it Reddit or Pinterest? It took that long. No, it was Reddit. Sorry, it was Reddit. So you're talking about these long tails. There's going to be hard times. Like, hands down, there will be. There's going to be headwinds, and you need a founder that's going to march through and get through it.
And what's really interesting is that you're actually betting in a established product for a unique niche that you're already in, versus some pre-seed investors invest with the team with new concept. Let's talk about Twitter, which was basically, it was a 24-hour follow the founder around on TV and watch them, and then Twitter just came out of it. That became X. So we see a lot of that for that pivoting, but because you're starting with the product, you don't have really that.
No. And by the way, but is it possible that the product ends up like doing that in a sense where it's like, yeah, correct, they're already in product, so they have some investment, but we've seen like companies go, yeah, this is working, but this little side thing's working better. We're going to kind of switch gears and go this way. And it's like, it can be a little scary, because honestly, you feel like it's like, that's not what I invested in, but that's where you have to hope that the founder is going to make it work.
Perfect. I can keep on talking about this forever, and I'm fascinated by the different aspects.
Yeah, we've had that. We've had founders pivot to something we don't agree with, but that's kind of the blessing and curse of a VC. It is my problem in a sense, but that's also the portfolio strategy. You're going to get some crazies. And you also you hope that they have more insight than you do and more context and are smart enough to make the right decision, because you are bird's eye view. And so you just got to trust sometimes. And it's one of those, we'll see until the outcome. Like, even if it looks really bad right now, and we have one deal that just like seems to keep coming back to life in different ways, that I'm like, at this point, I'm not going to write it off in terms of like mentally. Like, I'm just like, we'll see what happens. Because by the way, the best way to wealth is to survive.
I love the model, and it's fun versus private equity, which is really, it's managing things and driving it and really inserting themselves. And it's a different model altogether.
Well, and I'd say private equity is about mitigating your downside, whereas venture is about maximizing upside. And that's truly the difference that I see. And growth equity falls somewhere in between. But like, true private equity is trying to buy things for as cheap as possible, financially engineer them, and sell them for more. Like, that is the model. So they're going to grind it. They're going to try to undervalue you. They're going to retrade. They're going to do, and that's not everyone, but it's a lot of private equity is going to play that game, because they're trying to make their money on the buy, which again, I don't fault them. I get that business, but I've hesitated to want to go down that path more recently because unless it's a company that really wants to partner for the upside, it's not that interesting to me.
And especially with the future of Hawke. So Erik, we're out of time today. And so what I'm excited about is I appreciate the time today, the insights. I hope everyone who's listening understands those. There's so much just learning and lessons through the podcast. So hopefully they can pick up on that. What I'm excited about is we get to be together. You're speaking at DealCon Live, our CEO M&A Summit for founders and CEO of brand and agencies. It's in Nashville, September 23rd to 25th. Really excited to have you and see you there.
When our venture team's there, so I get to actually see them in person, which will be fun.
Thanks, Erik.
Yeah. Thank you.